Hi, my name is Stuart and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And welcome to the second last in the 8-series episode on me comparing Investopoly to Wealth by Design. I hope it's been useful. It's been kind of interesting for me to kind of reflect on, the changes over the last 8 years and how the book is different. And hopefully some people have already received the book if they've pre-ordered it, and it's in bookstores now, which is great. So I'm really looking forward to seeing how well received it is. And of course, if you like the book and enjoy it, please leave a review on Amazon. I mean, I've already asked you for a favor in terms of buying the book. I loathe to, ask again, but it would really help. The more reviews we have on Amazon, it does certainly help in terms of getting the book noticed and, more people buying it and reading it. I don't make any money from, I get a royalty, but, if you add up the amount of time it takes to produce a book, no one's doing it for financial intensive, that's for sure. So the goal really is to put something out there that you can be proud of, and I'm proud of it, and that benefits and helps as many people as possible. And it can only do that if people actually read it and then take action afterwards, which are hopefully the Notebook LM tool is the conduit in doing that. And it really helps people. I think if people kind of understand, yes, the concept, and then they can bridge the concept to their personal life and how they're going to implement that new information, I think what it does is greatly increase the probability of actually the book's information creating positive change. And that's what I'm really excited to see. Anyway, that's the theory. No one's done it before. That's the theory. Let's see how it goes. Okay, let's get into rule number 7. And back in Investopoly, rule number 7 was only invest in investment grade property. I've reframed the rule to only invest in property with enduring, scarce and growing demand. And that's not just a play on words. That's an important difference in the approach, which of course I'm going to talk about today or highlight today. I wrote back in Investopoly, there's never a bad time to buy an investment grade property. I would like to delete that sentence now. I think understanding market cycles is more important today than it's ever been, and arguably has been important over the last 30 years. And genuinely, it's something that, didn't really resonate with me back in 2018, which is a bit embarrassing to admit, because it's certainly, I guess it's embarrassing to admit any fault or lack of knowledge. It's natural. Everyone, hopefully progresses with their knowledge base and experience over time. But certainly back then, when I wrote the book in 2017, 2018, it wasn't an important concept, where it's a much more important concept. And as I spoke about previously, a value-aware asset allocation, which I spoke about in rule number 5, applies just as much to shares as it does property. Now let's talk about why rule number 7 is important in terms of buying property with enduring underlying demand. The reality is that asset selection in terms of which property you purchase is absolute key. So it is really the inverse of share investing. With share investing in developed markets, not so much in emerging markets, but in developed markets, it's what you don't invest in that will hurt you. I can't remember the stats, but it's something like when you have an index, like an S&P 500 index, of those 500 stocks, most of the return in the index comes from only a very small few stocks. It was something like 20 or 50, something of that range. So it's what you don't invest in that will hurt you. With property, it's the inverse. It's about avoiding all the average or dud properties and finding the needle in the haystack, and not trying to find the diamond, but trying to find the pink diamond. So really the whole success of a property strategy, most of the success, I should say, of a property strategy is already determined once you've signed that contract to sale. That's really 80% of the heavy lifting in terms of how much wealth you're going to accumulate is done by the decision of which property to buy. Once you've done that, then you can play at the edges in terms of how you're funding it, how you own it, how you manage it ongoing, whether you make improvements to it, all these sorts of things. But at the end of the day, the location and type of property is really going to dictate the outcomes over the next 1, 2, 3, or 4 decades. So the cost of making a mistake isn't money. The cost is time. And obviously, time is a necessary ingredient. If we go back to the wealth equation is investable surplus cash flow multiplied by investment efficiency multiplied by time. Time is a very, very important factor, and we need to recognize that. So if we're going to allocate some of our surplus cash flow towards a property investment, and we want to make that investment as efficient as possible, certainly negative gearing used to do that, and then multiply by time, we just need time to really do all the work for us, because when we've bought the right asset, in the fullness of time, we'll be able to enjoy the fruits of that good quality decision from the outset. Let's just recap what I talked about in Investopoly. So in Investopoly, I talked about investment grade property, and I really defined investment grade property as property that can double in value every 7 to 12 years on a perpetual basis, or at least not infinitely. It's at least perpetual over our lifetime. So at some point, mathematically, it has to level out, but over our lifetime, that's what we need to consider. 7 to 12% is like roughly 6 to 10% in terms of capital growth, just to sort of put some numbers around it. I talked about that there's grades within investment grade, so you can kind of have an entry level investment grade property, which might be an older style sort of 2-bedroom apartment, and you can have, AAA kind of grey rated. I mean, there's no actual mathematical ratings around this, but you can have a fantastic investment grade property, which would be a house on a large block of land in a very tightly held area with a lot of excessive demand and virtually no supply, along those lines. I said that investment grade assets had 3 attributes. Strong land value component, because obviously land appreciates, buildings tend to depreciate over time. Scarcity, meaning that scarcity in terms of location, in terms of architectural style, and scarcity means that you're always going to have far more potential buyers than you will available properties to buy. And the last one is proven performance. So that is, we want to be able to look at that asset and very comparable assets like it in a very close proximity that have built up a good data set that demonstrates that these things have grown at those investment grade rates over multi-decade periods, not just looking over the last 5 to 10 years, which is most of the available data, but is too short a timeline, particularly if you're making a multi-decade decision to buy and hold that asset. And as I said at the beginning, at the intro, I said there's never a bad time to buy a great asset or an investment grade asset. Now, that's one very important point that I've changed my mind on since Investopoly, or maybe I've just become more educated, more experienced. Look, quality is still incredibly important. There's no moving away from that. I mean, if you buy a quality asset at the wrong time, in terms of the wrong cycle, it's really then a question of how long you own that asset for, as in whether it's going to deliver the returns you're looking for. It's a bit of a word salad there. What I'm sort of saying is, if you buy at the wrong time, which is just at the end of a growth cycle, just before a flat cycle, but it's a high quality asset, and you hold that asset for 30 to 40 years, you'll be fine. The asset will do its thing. The average growth will be great, but it's just not ideal. So that's why I think that you've got to be really careful about buying a quality asset for an attractive price. And when I say attractive price, a high quality asset that has strong underlying demand strategically can't be purchased below intrinsic value. So it's very difficult to do that. It's impossible to do that. Look, you could be lucky in terms of timing, or lucky in terms of, right place, right time. I've done it, where I've bought a property and I've looked back and go, well, I got that for much less than I think it's genuinely worth. And of course, it's easy to think that, because when you make a purchase, it's natural human psychology to talk yourself into that purchase, but genuinely looking at the comparable sales. So that can happen, but it's not by design. It's really by luck. When I say attractive price, I think by relative value, relative to, where other states in Australia are sitting. And the reason why buying hopefully just before a growth cycle or earlier on in a growth cycle is advantageous is for a couple of different reasons. If you get growth in the early years, it means you can leverage that growth, whether that you can use that equity to borrow to invest in shares, do those sorts of things. So it does sort of propel your advancement towards your financial goals. Also, it feels good as an investor, particularly a first-time investor. If you can buy a property, and as we've seen on Tuesday, I answered a question from a listener that purchased a couple of properties and have seen a 40% uplift already. You've got a high level of confidence with those assets now, and you'll stick with the strategy. But also, life happens. Life gets in the way. So one of the best ways to mitigate buying an unlisted, illiquid asset is if you need to change your mind 2 years down the track, all you want to do is be in a position where you're not going to lose money. And so by buying well and buying at the right time of cycle, if something unforeseen happens, and you do need to then sell that asset, within the first 1 to 5 years, then at least you can probably do that and walk away and not make a capital loss, which is incredibly important. The other thing too is that, the cycles are real. It's in the data. We can obviously clearly identify it. And probably the, most obvious cycle that I kind of first picked or experienced, and I don't want to say I picked a cycle because it sounds so wanky, but, was really end of 2017. Remember, that's when I wrote Investopoly, so it was just too late. But I remember, and I've mentioned this in a blog before, I remember holding a seminar in our office in Melbourne, a lunchtime seminar where I've still got the slide deck, where I talked about Brisbane and why I thought Brisbane was set or primed for growth. And really from 2018, a lot of clients that invested in 2018 have doubled their money. So I'm not patting myself on the back. I think that the stuff that I sort of teach or demonstrate or talk about, the evidence, once you realize it's there, it's kind of obvious. It's not rocket science. But, that's the first situation where I really sort of analyzed it and then had the conviction around it and had the investment conviction around it as well. And so if we know those cycles are real in terms of property tends to go through a flat cycle and then a growth cycle, the length of the flat cycle dictates the length of the subsequent growth cycle as well. So if you look at Melbourne, for instance, Melbourne had a 20-year growth cycle, especially in apartments. Apartments over a 20-year period performed much stronger than houses. So actually, I just pulled up the chart. So Melbourne, 1997 through to 2016, for houses, the growth rate was 8.4%. And for apartments, between 1997 and 2010, it was 10.7%. Now, if knowing what I know today, back in 2010 or early 2000s, I probably wouldn't have invested in apartments knowing what I know now. So it shouldn't surprise us, I guess, that after such long growth cycles in Melbourne, Melbourne's experienced a flat cycle of about 10-ish to 13 years. That mean reversion will reverse around and we'll see another growth cycle. But that's one of the big differences, I think, between Investopoly and Wealth by Design. Now, the next thing is, remember this rule is called only own property with enduring scarce and growing demand. So enduring scarce and growing demand, that was a really deliberate point to add that part. So that part was really around understanding, I've done some podcast episodes about this, but understanding who is the potential buyer for this asset. If I'm going to hold this asset for 20 or 30 years and I want at least 7% compounding capital growth, who's going to be able to afford that asset in 20 or 30 years? Because it's probably not the average Australian. It's probably not family whose income grows at the average sort of income growing rate, 4.5%. Typically, that's what incomes have been growing at in Australia. It's probably not them. It's probably going to be someone that has, other sources of wealth, inheritance, business, employee share ownership plans, these sorts of things, RSUs, those sorts of things, family wealth, whatever it might be, but other sources of wealth. Or maybe their income is growing at a much faster rate. So maybe people in business or high income earning executives, these sorts of things. They're the cohort that are going to be able to pay 4 or 8 times the value of property in 20 to 30 years from now. So that's where the growing and enduring demand comes from. It's really about understanding or buying an asset that is going to appeal to a number of different potential buyer cohorts that have the financial capacity or will have the financial capacity in 20 years or 30 years time to pay you a lot more for that particular asset. And this is where I think a lot of investors make mistakes because they buy in locations where the only capacity to be able to pay more is driven by and linked to their income increasing capacity, how much a family's income increases and their borrowing capacity. But they're the two components that can move. You either earn more so you can borrow more, or borrowing capacity loosens up and you can borrow more. They're the only way in some locations that some locations can move forward. And what happens then is that location, outer lying suburb, it gets up to the median value and then it holds there, only increases by inflation or maybe wage growth, 4%. And then it moves out like a ripple effect into the next land release area. The next thing I spoke about in Wealth by Design is that investment grade doesn't necessarily have to be a location. So you might be able to have a property with investment grade attributes in a secondary location or secondary suburb. So I think that's important to really understand as well. So for people that, can't afford to get into a blue chip suburb, you can still apply these principles, or those you might compromise in terms of quality, can still apply the investment grade principles in terms of buying something with enduring demand, strong land value component, scarcity, proven performance, all those sorts of things, locations other than blue chip suburbs. So really to recap, I think the way I'd describe it is Investopoly really described quality, asset selection. The big change in Wealth by Design is, yes, buy a quality asset, but buy it at an attractive price. Think about relative value in terms of what the value, the best example of that is Melbourne versus, say, Brisbane, or Melbourne even versus Sydney, or Melbourne versus any state, really. The comparative value is compelling and it's obvious. It's not incremental, but it's compelling. So when something is compelling like that, just like Brisbane was back in 2017, you could buy a really good investment grade house for about 800,000. In Melbourne, that was sort of costing 1.2, 1.3, 1.4. So the value was compelling, even relative value, because obviously Brisbane is a smaller market. It doesn't have as many employment opportunities. I know some of our clients that are in sort of senior executive roles can find it difficult to find those roles in Brisbane, where a lot of head offices tend to be, for listed companies tend to be in Melbourne and Sydney, and multinational companies as well. And finally, the second big improvement was really understanding and thinking about future buyer pool and really being critical about that. I think that's the big mistake, the big thing that people miss currently at the moment. Okay, next week is last in the series, rule number 8, which is remove every risk as possible. That was a pretty boring chapter, I think, in Investopoly. It was all about, personal risk insurance like life, TPD, income protection insurance, and put a will together. But I've extended that to really understanding, it's really turning risk and reward on its head. So trying to achieve the highest risk for lowest return. How do we pull risk out of an investment strategy? So I'll talk about that next week. And if you haven't purchased Wealth by Design, I would certainly encourage you to do that. It's out now, so you'll be able to get it in your hot little hands. And it should be in bookstores as well. And of course, if you know anyone that might benefit, either share this podcast episode or please direct them or suggest they buy the book. I'd greatly appreciate it. And good luck with the Notebook LM model. I think we can use it with property. You could put in a property address or give it the attributes and ask it, what the book would say, or to build a checklist relative to this type of property or location. I mean, you can play around with the prompts that you can use, but I think it'll help you apply those principles. Okay, I'll leave it there for today, and until next week, bye for now. Okay, before I wrap up, just one favor to ask. If you got something out of today's episode, the best way to support the show is to leave a rating on Apple or Spotify or wherever you're listening. A couple of ways that I can help you in return. If you want to submit a question to the show, the email is in the show note. Also, we've got 3 downloadable guides, which you can download off our website. One's a very detailed report on how to choose the best super fund. We've got a debt recycling starter guide, and we've also got a decision tool to help you navigate the tax changes. And finally, if you haven't already grabbed a copy of my new book, Wealth by Design, it's out now and it's got a very useful AI companion tool with it. Anyway, I'll leave it there, and thanks for listening. Until next time, bye for now.